And I'm going to introduce our guest today, Ted Lanzaro. He's a certified public accountant, a real estate investor, a real estate broker, author, speaker, with over 30 years of real estate tax consulting and investing experience. So I'm so honored to have him here with us today. He runs Landmark CPA Group, a boutique CPA firm specializing in accounting and taxation for the real estate industry. For the past 30 years, he's helped thousands of real estate business owners, entrepreneurs, and investors all over the United States implement cutting-edge tax strategies that save them thousands of dollars annually. He's also the author of the Tax Smart Landlord and the Tax Smart Landlord Toolkit. Awesome. And has authored over 100 articles on taxation for the real estate industry, focusing on the investor, landlord, syndicator, and developer. So Ted, thank you so much for joining us today. I would just love, let's just kind of open it up with just a couple questions. How did you get started and specializing in not only just taxation, but real estate taxation?
Right. Yeah. So, 30 years ago, when I got out of college, I joined a CPA firm, and I ended up joining a small CPA firm in Boca Raton, Florida, where I was living at the time, Southeast Florida. And that's real estate was what was going on there at the time, because there was about 1991, things were booming. They were building out all over Southeast Florida. So there was a lot of development, and it was just a crazy time down there. And so we represented a lot of real estate people. And so I kind of got started, that was the clients that I was assigned, literally, right? And I had gone to high school down there. And at some point around, well, it was probably 10 years into my career, around 2000, a friend of mine came to me and he said, we should read this book, Rich Dad, Poor Dad, right? And this book that's launched a zillion real estate investors, right? And he's like, read this book. We got to start investing in real estate, And I said to him, I said, yeah, I said, I think you're right. A lot of my clients are doing really well. I do all their taxes, and, we got to, see, how we can kind of get into this, right? So three knuckleheads, we all went to college together. We, we are high school together, and we actually went to college with a couple of them also. And then we go out the first day, we go out with a real estate agent, and we end up putting contracts on 3 single-family houses in Fort Lauderdale that day, literally, right? So we started our rental landlord business, right, by buying a handful of single-family houses. And that worked up until about 10 houses that year. And the next year we bought a couple of small apartment buildings, and we started buying and flipping houses also. And man, we made all the mistakes you could possibly make. We had no education, nothing, just doing it by the seat of our pants. And I started networking at these real estate investment club groups locally around South Florida. And one of them actually said to me, hey, we heard you're a CPA. And I said, yes. He said, well, do you work with real estate? And I said, yeah. I said, a lot of my clients are in real estate, and I'm an investor also. And they're like, great. We need you to come and do a presentation for our investor group, right? And I had never done any public speaking at that point, right? Now it's been, it's been 20 years. I could do this stuff in my sleep, but back then I literally got up in front of a PowerPoint with, my hands and knees were shaking, right? And all I did was read off the slides, and but at the end, I got everybody clapped, they gave me a little ovation. And, I ended up walking out of the room with 4 or 5 clients that night, right? So I'm like, wow, there's something to this, So I started refining it and started getting more opportunities to speak. And the more I did it, the more people found out about it. And it just turned into, my niche. right? And now I don't take any, if you call me and you say, oh, I run a a candy store or a flower shop or whatever, I just refer you, somewhere else. I don't take anybody who's not involved in the real estate industry these days.
Wow. I mean, that's awesome. Yeah, you're right. That little purple Bible that's launched thousands, tens of thousands, like real estate careers. I know that was the book that got me into real estate as well. Wow, back in like 2002. So,
Yeah.
well, yeah. Well, so everybody here is just chomping at the bit to ask you tons of questions. I'm sure you get the same response anytime that you walk in a room full of real estate investors. So I'd love to kind of dive in here. We're focused here on passive syndication and self-storage funds, note funds. I would love to just kind of start off the conversation there. Like, what are some of the general tax benefits of investing in syndications that all like limited partner investors or potential investors should be aware about?
Yeah, I mean, there's a lot of them. I mean, look, the primary reason people should want to invest in passively in real estate syndications is basically for the tax-free cash flow, right? And so the cash flow that is distributed from the net income, the net operating income of the apartment building or storage or whatever the passive investment is doing, is typically offset by the depreciation. So you'll have money in your pocket, you'll get checks, right? But when it comes time to get your K1, the K1 will have a negative number on it typically, at least in the first, 3 or 4 years at least, right? And usually in the first year, if it's an apartment building or any other kind of investment real estate, it's going to have a big bonus depreciation loss typically in that first year, right? So you end up getting these distributions that in essence you don't have to pay any tax on in the year you receive them. Now there's a tax treatment at the end when you get out, but in the years that you're receiving them, you don't have to pay taxes on them. And look at it this way. So I always tell people, if and I deal with a lot of people out in California, for example, right? So if you live out in California, you probably pay 40% in taxes. If you're a high income tech person or whatever, you're paying 40% in tax by the time you do you pay the IRS and you pay the state of California, right? So if you make $400,000 out there, right, a year, you're probably paying something like $160,000 a year in taxes. That is a ton of money. That is literally the definition of I work 3 days for myself and 2 days for the government, right? So as a passive investor, if I can start to build a stream of tax-free cash flow, right? Even if I don't qualify to take the large depreciation losses against my earned income, right? What I can do is I can build this stream of passive cash flow. So now let's say after a couple of years, I've invested in enough deals that I can literally produce another $100,000 of passive cash flow, right? Well, now my income is not 400,000 anymore, it's 500,000. The 400 I earned from my company plus the 100 I get from my passive investments. But I'm still paying $160,000 in taxes, right? Because I'm only paying on that 400,000. My tax rate, which was 40%, right, is now down to about 32%. 160 divided by 500,000. So I've effectively lowered my marginal tax rate by about 8%. And that's the goal that all passive investors really should start with, right? Now, the other things that you want to take a look at is if I'm a passive investor and I have other active real estate investments, right? Or other more mature passive investments that are throwing off net income, right? Or I have my own rental properties that are throwing off net income. I can use the passive losses that pass through from a syndication to offset my net rental income from other sources, right? So that's a great way to use passive losses. Even if you can't use them against your ordinary income, you can use them to offset your net rental income, right? So as an example, I have a client who has a ton of properties he's owned forever. There is no more depreciation on these properties. And he doesn't, his mortgages are basically paid off too. So these properties that he owns are literally cash cows. They just, and he shows like, you know, $100,000 a year or more in net rental income. So every year he invests in a passive, you know, in a passive deal and literally wipes out that net rental income. So he doesn't have to pay taxes on it. So that's a really good example of, you know, a good way to use the passive losses. The other way that, and this is one we use all the time, is you can use passive losses to offset capital gains from the sale of other rental properties, right? So if you're selling, so just as an example, I've got a guy who sold an apartment building this year. He's got $1 million capital gain, right? What did we do? Go out and buy some buildings this year. And by the way, we knew about this in advance, right? So he's like, well, I don't want to do a 1031 exchange because I don't want to be tied to the timetable in order that I have to do to make that work. I want to be able to shop. Now this is, he sold this property like in February or March, right? And this is what I'm telling my clients all the time. Let me know when you're doing things, you know, right? I need to know in advance whether you are buying, whether you are selling, or whether you are renovating a property. And the reason I need to know that is because there's stuff that we can do in advance that we can't do after December 31st or after the closing of the property. So in this case, we already had a plan. Look, you've got this huge gain. You don't need to do a 1031 exchange, but you do need to go out and buy some buildings because the bonus depreciation on those buildings will offset the capital gain and you won't have to pay any taxes on it, right? Yesterday,
so let's pause right there for a second. For people who aren't aware, I mean, we've talked a lot about depreciation. What is bonus depreciation? How is it calculated? I mean, not the math of it, but like how, I mean, you know, how do we get the bonus depreciation and how, and why would we want to do that, you know, right now?
Yeah. So typically what happens is, so think about this. So depreciation is nothing more than the rational allocation of the purchase price of a building allocated over what the IRS says is the useful life of that building, right? So typically the IRS says if it's a residential building, the useful life is 27.5 years. If it's a commercial building, like a shopping center, office building, self-storage, the useful life is 39 years, right? So typically what happens is, typically what happens is that you want to do what's called a cost segregation study. And a cost segregation study basically breaks out the component parts of a building. So the typical thing, if you don't do a cost segregation study, the typical thing to do is, let's say we buy a $5 million apartment building, right? What most accountants will do is they'll say, okay, there's an old like rule of thumb, 80% building, 20% land, right? You know, so they'll say, okay, the land is not depreciable, so we're gonna allocate $1 million to the land. We're gonna allocate $4 million to the building, and it's an apartment building, so we're gonna depreciate it over 27.5 years. $4 million divided by 27.5 is, oh boy, I would have to do that on the calculator, but yeah, it's a, you know, I don't even know what it is. It's 75 grand a year, give or take, something like that, right? It's actually $145,000 a year. Okay, right? So it's about $150,000 a year. Instead of doing that, right? and that would offset the net operating income of the building. And typically that's enough to offset the net operating income of the building, at least in the first few years, because you've got the high mortgage interest, right? So now instead of doing that, we can elect to do a cost segregation study, which allows us to break out the 5 and 15 year property that's within every 27.5 year building, right? So 5-year property is anything that I literally can unscrew, unplug, somehow disconnect and walk out of the building with, right? So think about an apartment building, right? What's in an apartment building? Kitchens, right? So it's all of the appliances, all of the decorative lighting, the cabinets. I can unscrew the cabinets and take them out of there. The vanities, the mirrors, the toilet, the tub, the sinks, right? Decorative lighting, shelving, all of this stuff. Now, so if you buy a 100-unit apartment building, there's 100 sets of those, right? And then 15-year assets are what are called land improvements. Land improvements include things like the parking lot, fencing, sidewalks, not the one in front of the building, but the ones that lead up to the individual units from the parking lot, shrubbery, all kinds of things that you would have in land. In a mobile home park, it's all of the electrical stuff that literally, is underground to each of the pads where the mobile homes sit, right? So it's all of that sort of electrical and piping infrastructure, sewage in an apartment building, that sort of thing. So what the IRS says is we can break those things out. And as long as we break them out and have an engineer and an appraiser do the work and formalize a study, then we're allowed to take those and reclassify them to be depreciated either over 5 years in the case of what's called tangible personal property, or over 15 years called land improvements, right? But then the IRS comes in, and we've been doing this. I've been doing this for almost 30 years, and people used to be like, "Woo, we get to reclass stuff over 5 years. That's awesome, right?" Well, then the IRS made a rule that says, okay, if it's a 5-year asset or a 15-year asset, you can actually depreciate it in year 1, the entire amount. Okay, and that's what bonus depreciation is. You get to take the entire amount of the 5 and 15 year and take the depreciation deduction in year 1. So what does that typically do? It creates a huge tax loss in year 1, right? So let's take that $5 million building example. The national average for cost segregation studies on apartment buildings is about 25%. So we would take the $4 million piece, the building, and there's probably at least 25% 5 and 15 year. So you're talking about $1 million worth of cost segregated items, which translates into literally $1 million depreciation deduction, right? Now, if you're a passive investor and you own 1% of that property, right? Well, then you're going to get a K1 that with 1% of $1 million on it, basically a $10,000 loss. Okay, that's your piece, right? Doesn't matter how much distribution you could have gotten. You could have invested your $100,000 and gotten, $8,000 to $10,000 in distributions that year, right? But your K1 is going to say negative $10,000, right? So what happened was I got this money, but I didn't have to pay income tax on it because my K1 is negative, right? Now, let's assume, just for an example, that you're now that passive investor with that big, that $10,000 loss, just as an example. Well, now we can do what we just talked about. We can apply it against other net rental income. We can apply it against net capital gains from real estate. Okay. The worst case scenario is we don't qualify as a real estate professional. We're not actively participating. We're limited partners. So it's got to carry over, right? So what is it going to do? It's going to carry over to next year. We can't use it we'll just sort of bank it, right, for future years, right? And then that's typically, so then now you go into year two, right? There's still enough depreciation on the books that typically in years 2, 3, 4, 5, you're going to still get your $8,000 to $10,000, distribution, and you're still going to have some sort of a loss in your K1, right? And then, so what have you done? You've picked up this stream of income that you never have to pay taxes on. And along the way, if you're not able to take the losses, your passive loss carryover, your bank of losses, is just accumulating, right? So when do I use that? Well, I get to use it when one of the following things happens. I have other net rental income. Now I can just use it. It doesn't matter what year. If I all of a sudden I have net rental income on a new property in year 5 and I have this accumulated passive loss, I just wipe it out. If I have a sale from another syndication, I use my passive losses to wipe that out, right? Worst case scenario, let's say you're only in one deal, you use the passive loss carryover when that deal sells. That deal sells, there's a capital gain on that deal. You end up wiping out whatever the income effect of most of the recapture part of that is, because all of your losses were created by depreciation. So the carryover basically wipes out any recapture that you actually have. And then what you're left with is paying taxes on the difference between what you put in and the total amount you got back. So if I put 100 grand into the deal and I get $50,000, I get, $40,000 over 5 years, 8%, and then I end up getting 120,000 back upon the sale of the property. Well, then I invested $100,000. I got $160,000 back, right? And I'm only going to pay tax on the net difference, about $60,000. Now that's a simplified example, right? But because everybody's scenario is different, right? I can't give you a really specific example. That's a general. So I have to be generalized about it. But that's why you should, if you're going to be a passive investor, especially if you're going to be in multiple deals, you really should have a CPA who understands that business so that he can guide you along the way of how to use what your ability to use those losses are.
Awesome. So that is like one of the biggest questions that a lot of people that are on here have is like when an asset goes to sell, we all want a capital gain. We're hoping for the capital gain, right? That means the asset has been successful, right? The business plan has been successful. So, you talked about the suspended loss carrying forward. I mean, I take it doesn't expire, so you can use that loss to offset any gain, not necessarily on that asset, but potentially other assets that sell. What are some other ways that an investor might be able to, defer the tax?
Yeah. So I've kind of come up with a handful. So if the syndicator wants to do a 1031 exchange and everybody kind of is along the ride with that, well, then the actual entity can just 1031 exchange into a new property. So that's always one option, right? And typically that's something that is discussed, in advance of the sale with the investors, right? With the investor pool. You say, okay, look, we've got this opportunity to get out of this and get into something better, right? Because that's the whole idea of a 1031 exchange. You want to get into something better. Matter of fact, in this market, I'm telling all of my clients, it's easy to sell a property these days. You can sell a property in, a week, literally. If it's a good property, you can sell it in no time. We literally sell good buildings in less than 2 weeks, right? My brokerage. So the thought process is find something better. If you're making 8% on a building, don't sell it until you find one that's making 9% or 10%, right? Buy something better, right? Because here's the thing, and it's actually kind of funny, but a lot of people will come to me and they'll say, oh, I'm going to sell my property, right? And I'm not talking even the big stuff, the really big syndications and stuff. I'm just talking about, Joe Investor, who's got, a few, 50 unit apartment buildings or 20 unit apartment buildings. They'll say, I'm going to sell my building. Why are you going to sell your, and I'm going to do an exchange. Well, have you found something better? No. Why are you going to sell the building? I don't know. I've owned it a long time. Right? So basically what he's saying is, I'm selling my building because I'm bored with this building. Right? Does it make money? Yeah, it makes a lot of money. Why are you going to sell it? Right? Have you found something better? No. So it's just, it's almost like, so I always tell people, look, you need to find something, find something better, right? If you're gonna do the whole exchange process, then generally speaking, it should be into a better property, right? So now the other ways to use things like the passive. So think about this, right? Let's say I'm a business owner, right? And I own a business and it throws off a lot of earned income, right? But maybe I pretty much live off the earned income, and then I either live off the earned income or whatever earned income I have in excess, I'm investing in passive investments, right? If I make $500,000 a year, I live on $400,000 a year after my taxes, and I have $100,000 a year to invest, right? Well, so now what I can do if I build up, let's say I haven't funded my retirement plan in that whole calculation, right? So now I can take the passive cash flow I'm getting from my passive investments, right? Maybe I have a stream of them that pay me $100,000 a year. Well, I can take, $30,000 or $40,000, and maybe I can fund my 401k and a profit sharing on top of it or whatever. I can't take the passive losses against my ordinary income, but I can reduce my ordinary income by using the cash flow from the passive investments as a vehicle to fund my deferrals. So I can fund my 401k with it. I can fund my profit sharing. I can fund my HSA. I can fund 529 plans for my kids that'll give me maybe a state tax deduction. So I can do all of these deferral kind of things, right? So, and if you're a passive investor who's a W-2 employee, right? And you're not maxing out your 401k plan at work, well, then use the money to max out. Make sure you're maxing out. So, I just saw a question pop up on the screen. You're still funding so I want to be clear about that. You are still funding the retirement plans from your active income, but because you're taking that money away from the money you'd be using to live on, you're then supplementing it with the passive investment money. But it's because you have that much more money that you're able to both pay your bills and make sure you fund your retirement, right? And the same thing goes with, like, let's say you're a dual income family, and I see this all the time. Dual income families making $500,000-$600,000 a year, and they're not maxing out their 401ks at work, right? They say, so, well, my wife doesn't like to max out the 401k, right? No, that's how you're going to get the deferral, right? You've got this extra income coming in from your passive investments. So use the money you're making at your job and make sure it all goes into every deferral vehicle you can possibly find, because even if you can't take the passive losses, you can fund your active deferrals and use the supplemental money to continue to, as extra money to pay your bills or to put into new investments, right? So those are other ways to basically look at the situation, not in the traditional way, but look at it and say, okay, yeah, no, I understand I'm not going to be able to offset this against my ordinary income, but look at all the things I can do with the money that save me money on my taxes. And look, if you're that $400,000 person paying $160,000 in taxes, and you can put away, 20,000 for yourself and 20,000 for your wife and your 401ks in 2022, well, you just saved $10,000 or $15,000 on your taxes, right? It's a lot of money, right?
Is there ever a situation that you're paying taxes on the distributions, or is it only capital gains tax on the actual gain on the sale of the property?
Yeah, it all comes. So you have to think about this, right? So I used a very simple. It's actually pretty complicated, but I'll use a simple. I try to make it simple before. The simple answer is that let's say I start with $100,000, right? And every year when I get my distribution, my capital account decreases by the amount of my distribution, right? So let's say, for example, and let's just use round numbers. Let's say I put in 100, and every year I get a $10,000 distribution, right? Assuming, so now my account went from 100 to 90 to 80 to 70 to 60, right? 5 years in, I've gotten $50,000 on 100, right? All of which I haven't paid any taxes on. Now the property sells, and I get back $120,000. Okay, what ends up happening is the net tax effect of that whole transaction is, and simplified, but the net crux of that whole situation is that I put in 100 and I got back 170. I now have a $70,000 capital gain. And depending on just like if I bought a stock for 100 and sold it for 170, right? It's literally the exact same thing. And so I end up with a $70,000 capital gain, which the max, at least right now, the max rate would be somewhere around 22% federal with all the surtax stuff and whatever your state is on top of it, right? So that's a simplified answer. I know it's probably not the one everybody kind of wants, but that's really the reality of how it works. And somewhere in the middle of that, your passive loss carryover wiped out your recapture. That's the other thing to remember. As long as you didn't use it, right? If you still have all the carryovers from that property, then when it's time to sell, the first thing that happens is your passive losses wipe out the recapture, and then you have the capital gain portion. But the capital gain portion, the taxable part of the capital gain portion, is going to be based on what did I put in and what did I take out, and the net difference is going to be essentially what the capital gain is, give or take.
Awesome. Guys, I have literally 150 personal tax situation questions that have come through, and I just want to let you know I'm asking Ted questions that are going to capture 80% of those questions. But always, as Ted said earlier, make sure that you are working with a professional in advance to understand how all of this applies to your situation. And Ted will definitely, have you give out your contact information so people can get in touch with you if they need support. But I wanted to pivot really fast, in the time that we have left, and ask a question that I know that I get often when I talk to investors, and that is, what should I be thinking about from a tax perspective and how I invest? And I'm thinking if you're investing with cash through a self-directed IRA, maybe even a solo 401k. Can you kind of just walk us through like a 30,000-foot view of what we should be thinking at a high level on how we invest and how that might impact our taxes?
Yeah. So typically, this is one of those things where you will find people who will disagree with what I'm about to say. Okay. I don't see any reason why. So I invest passively. I invest passively in my own name. Okay. I'm a limited partner. I don't actively participate in the property. right? So I have no liability if the whole thing goes boom. All I can do is lose my money, right? So I invest in my own name. Why? I don't have any liability, right? There's no risk, I'm not going to get sued, nothing like that. Okay. Right. A lot of people, and there's several companies out there who sell, oh, you have to set up an entity and you should set up a Wyoming LLC to invest in syndications. Why? What does that do? Right. So the reason they tell you that is because that's what they sell. Straight, plain and simple, right? So if you're going to invest personally, it's okay to invest in your own name, right? And it's all going to your personal tax return anyway. Now, it gets that much easier if you're investing with your IRA or your 401k, right? Because if you're investing with your IRA or your 401k, none of what we talked about matters, right? All of this depreciation, recapture, whatever, all you're concerned about is if you invest with your IRA is how much money did I make, right? It comes back to what we were just talking about before. I put in 100, I eventually got back 150, right? That's all I care about. Return on investment, right? Because with the IRAs, with the self-directed IRAs and the 401ks, that's all that matters, right? Is because there is no tax ramifications. It's all tax-free as long as it stays in the account, right? And the UDFI. Okay, so there is a thing called UBIT, okay, unrelated business income tax, right? It does not apply to rental income. So you don't ever have to worry about, doesn't matter 401k, solo, IRA, whatever. There is no UBIT on rental income. Okay. Now, if you get into a development fund where we're selling condos and or something else where it's ordinary trade or business income, yes, then you can have some UBIT. If you're using your self-directed IRA to flip properties and you're borrowing money, yeah, you could have some UBIT, unrelated debt financed income. Unrelated debt financed income. Never heard of that. Never heard that term. Now, that doesn't mean it doesn't exist. It just means that I don't really spend a lot of time in the world of self-directed IRAs. It's a subcategory of UBIT. I'm just reading off of the thing. I have most of the and listen, it's only it only applies if you've got a K1 with a positive number. And typically that doesn't happen, right? So the only time, typically in a syndication, the only time you're going to see a K1 with a significant positive number is the year the property sold, right? And then capital gains aren't subject to UBIT either, right? So it's one of those things where people, it's something that people talk about a lot that almost never happens, right? Does it happen? Yeah, occasionally, right? Is it something that as a passive investor I would worry about? No. Why? It doesn't happen that often. It's rare, extremely rare, right? So it's not something I would worry about. If I was investing with my self-directed IRA, I could care less about that. What I care about is how much money am I making, right? How much more money is going into my self-directed IRA than I could get in another investment, right? Because that's really what I'm doing. I'm just doing, an investment allocation. I'm saying I prefer to invest in real estate as opposed to every other option there is.
Awesome. Yeah, because I know I get that question a lot. And I was like, it depends on what your investing goals are. And then if you have concerns, definitely get your CPA involved for sure. But it really depends on what your investing goals are. Do you need the cash flow now? Do you need the capital gains now? Or can you have it locked up inside of that retirement account, you're going to end up at some point in time, you're going to end up paying taxes, is my understanding. Whether it's, you liquidate the account now and use it, or or pay the taxes on that income and not put it in the account, or, at some later time, whenever you decide to start drawing on that account, you'll have, taxes then. So, but yeah, it really depends on everybody's unique situation. And I really loved how you helped investors understand that if you have enough income coming in passively, how you can actually use the passive live off the passive income and actually defer some of that active income and take advantage of taxes, that tax deferral now. That's awesome. So I would love to just pivot. We're almost out of time. For somebody who's wanting to start a tax strategy around this, wanting to understand what the next steps are with thinking through their taxes and passive investing, what is the first thing they should do?
I'm sorry, would you say that again?
Yeah, for somebody like a limited partner investor or a new investor who's wanting to invest in syndication, or somebody who just really hasn't given a thought around taxes and says, discovers, wow, I need to put together a tax strategy. What do you suggest the first thing they do is?
Yeah, I mean, look, it really comes back to what you were just saying. What are my goals, right? And so I want to sit down with my CPA and say, look, this is what I want to do. How is this going to affect my tax return, right? Because here's the thing, and you said it before perfectly. Everybody's situation is different. I speak all over the country now, and the first thing I always say to most investors, in an investor group is everybody's situation is different, right? So it all depends on about 20 different factors, right? And so those factors could be, W-2 income. Am I married? Is my wife qualified as a real estate professional? Do I have other rental properties? But there's a list of 20 different things. All of those things are factored in. So if I'm looking to get into passive investing, the first thing I'm looking at is one, how is that going to affect my taxes? What are my goals? Am I trying to produce, passive income? Do I have a relationship with a syndicator that I trust? Right? I remember I actually met Dan a few years ago at a seminar, right? And at a mastermind that we were both speaking at. And when he was doing his presentation, he was talking about the thing that he continuously emphasized was transparency, right? Well, how he basically is always transparent about, his deals and all of the things. When investors ask questions, he gives them the answer. Not everybody does that. That was very impressive. And we kind of formed a relationship because I went up to him afterwards and kind of chuckled. And I said, yeah, man, that's really important. Investor relations are literally the key to building a passive investment firm. I had no idea who he was at the time, right? Just knew that he was, in this business, right? And so it really, really impressed me. And there's literally a handful of, there's maybe about 10 people that I know that I would invest with, right? That have the track record, that have, that I consider to be, honest, transparent people who answer questions and treat their investors right and whatever. And it was just one of the things that I was really impressed with. So I think that's a big part of it. The relationship that you have with the operator makes a difference if you're a new investor, for sure.
Awesome. That's an amazing first step. And I want to draw out something that you said earlier, because I know I've been guilty of this. My CPA is a little slapping my hand right now. If you're going to make an investment, sell a property, buy a property, talk to your CPA first to understand how this is going to impact you. So that's a conversation to have in advance, not retroactively. So that, Ted, how can people find you and find out more about your practice and what you do?
So we have a website. It's www.landmarkcpagroup.com, right? My email is pretty easy. It's ted at landmarkcpagroup.com. And so if you go there, there's actually a, how do I get started working with the firm page, and you can fill out basically a web form that tells me a little bit about yourself and your goals and your portfolio and what you're trying to accomplish. And then we kind of take a look at it and see, whether we think we can make a material difference in your situation. And if we can, we take you on as a client. And if we can't, we tell you, look, because I have to be honest, there are times when, because I always ask, let me see your returns, right? I'll take a look at your returns. I'll tell you what I think, and I'll give you a fee quote, right? And a lot of times people send me stuff, and I get back to them, and I said, and because I'm honest about it, I look at it and I say, I think you've got a perfectly good CPA. Your fee is reasonable, and there's not anything more that I could do for you than they can do for you, right? So maybe you should stay where you are, right? They're doing a good job, right? If I think there's something there that I can make a substantial difference with, then I tell you that, and then I also give you a fee quote, because I'm specialized. I'm sort of like going to see the brain surgeon instead of your general doctor, right? So I'm priced accordingly, and so it kind of, does, I want to work with people who I can make a big enough difference with that they say, yes, I see the value in working with Ted. Ted was able to do this, that, and the other thing that resulted in me saving, $10,000 or $15,000. I was on a call today with one of your guys, who I won't say who it was, but I was on somebody who works for passive investing, and in about 20 minutes, I told him how to save $6,000, right, on his taxes. So that's what I'm talking about. Had I not been doing that for free, had I just, was going to do a consultation with him, well, then at the end of that consultation, it would have been worth him, to pay me $500 for that information, right? So I see a question about note investing. I understand note investing, but it's a little bit different than what I do. But that's the whole point. I want to be able to bring value to people's situations, or I don't want to charge them the extra fee, because it's a small, even though we live in a big world of real estate investing, it is in many cases, it's a small world, and you'd be amazed at how many people, especially because of social media, know that. And the last thing I want is somebody who feels like they didn't get a lot of value, saying, oh, that Ted Lanzaro, he didn't do a good job of my stuff. You'll never see any of that on any social media or whatever, because I can either do a good job or I don't do it.
Awesome. Well, Ted, you have provided immense value to the group, and I just want to wrap it up. If there's one thing that investors should be taking away from today's conversation, what is it?
Yeah, I think I'll give you one thing, which is be proactive about your taxes, right? The proactivity and good record keeping go hand in hand, but proactivity is so important. Talking to your accountant. If you don't have an accountant that you can talk to all year, and you're just bringing your stuff in March or April and getting your taxes done, I guarantee you are leaving money on the table, right? So being proactive is the absolute best way, and that's what we were just talking about before. Before you buy, before you sell, before you renovate, before you take any extreme taxable actions, talk to your CPA, because when people do that, they're amazed at the things that we can do to mitigate the tax effect that cannot be done after the fact. So if everybody takes that away, is proactive communication with your CPA is the fastest way to save money on your taxes.
Awesome. Ted, thank you so much. I know we have so many questions, that of individual tax situations, and guys, make sure to, pick up, Ted on, we dropped his email into the chat, as well as, you can just take the last portion for the page if you're wanting to get a consultation with a CPA. All right, guys, thanks so much for joining me today. Ted, thank you again. And we will see you guys next week when we talk about self-storage investing.
All right. Have a great day, guys. Thank you so much. Bye, Whitney.
Bye.